Okay, 11:02, almost 11:03. I just want to welcome everybody that's popped into the webinar. Today is this webinar with Judd Goodrich from MainShares and myself. MainShares, the title is SMB Down Payment and Capital Raise Solution.
Glad to be here. Thanks for having me.
And I got to figure this out. Something like why am I hearing a recording right in my ear, which is, man. All right, so here's what we're going to do. We're just going to start, and this is basically an introduction to MainShares and how I came upon it, just to tell you the story. So I coach people how to buy businesses, and the first thing I do is I teach them, hey, man, you got to find a good business. When you find a good business, you got to be able to take that to investors, and it could be debt investors. For instance, Heather over at Vicio. They could be equity investors. Now, last 5 years, that was not available. And MainShares has worked on this solution, is bringing equity investors. So that's what we're going to talk about here today and how that's done. Again, my name is Jon Stoddard. I run this podcast called Top M&A Entrepreneurs Podcast, and I have a business called Deal Flow System. It teaches people how to buy good businesses. And my other guest and host is Judd Goodrich from MainShares. Judd, you want to tell you a little bit about yourself?
Yeah, absolutely. So I got brought on basically when we launched to build out the platform of MainShares. So the full go-to-market, and pretty much what that boils down to is I'm working with almost all of our entrepreneurs throughout the search process, from finding deals, constructing offers, structuring deals, to setting up for a successful capital raise. And then, handing the keys over and letting them operate the business. But the core of what we're doing and like how we got here in the first place is actually started as like a business brokerage on the sell side. And we saw a couple of things. One is there's a lot of great buy side resources, but when it comes to what is the actual process and how do I go about raising capital, it was more of a, here's a list, go reach out to these investors, try to secure the capital. And then the second side is there wasn't a lot of readily available large check sizes to help partner with great operators to buy businesses in the SMB space. So our goal is effectively to create an ecosystem to enable great operators to buy good businesses alongside investors. And we're just getting kicked off, but starting to gain some good momentum. So excited to be here.
Fantastic. And by the way, we do have Heather, and Heather, just say hi to everybody. As you know, I've had her on my show. She used to work at Live Oak Bank. She's done 500 million in loans. She worked on a deal with me. So I am happy to have Heather here on this show too.
Well, thank you, John. I appreciate it, and I always like working with you and the folks that you've trained. And of course, now that I'm an independent, instead of just working for one bank like I did at Live Oak, at Vizo Business Capital, when you come to us, we represent over 30 banks, and we help people sort the deal through sort of a funnel of, out of those 30 banks, how many are going to like your deal? Maybe it's 10 or 15. And then out of those 10 or 15, which ones are going to be able to give you the best service and terms? And that's what we help you do. We take a lot of the debt raising burden off of people's shoulders so that they can focus on diligence, which we think is really a much better use of your time once you're under LOI.
Yeah, I just want to just show you how important that is, because there's some banks that love e-commerce companies and some banks that don't. Some banks love service-based businesses with 10 years of history, and some people don't like that. So it's really important to be a free agent in this versus just going to one bank.
Yeah. And I'm just typing in the chat. I'm no longer with the bank, Henry. I'm Vizo Business Capital, and you can find me on vizocap.net online. And you can certainly send me an email anytime. I'm on Twitter as well. And we are a loan brokerage for SBA acquisition loans.
Let's go to the next slide, which is what is MainShares, and Judd talked about that. But There's my first mistake on Canva. So this is what we're going to cover today. Number one, what success looks like with an equity raise in MainShares. Number two, structuring deals. Number three, engaging with investors. And number four, raising capital. So this is what we're going to talk about today. So number one, success. What success looks like? And I'm going to just cover these three things here. Just you should write these down because it's not going to change whatever it is. One, you've got to be an experienced operator. Two, you've got to bring a good deal. That's to debt players like Heather and to equity investors that Judd can introduce you to. And number three, an attractive offer. How are the investors going to make money and how are they going to get their money back? And what does that look like? So Judd, tell me a little bit more about what this success looks like.
Yeah. So from an operator standpoint, it's been an interesting 6-8 months or so. I'd say I've probably spoken to over 200 searchers, some that have owned businesses before, have roll-up strategies to, this is the first time I'm coming from like a corporate role and I'm looking to buy my first business. So I think there are some characteristics of folks that are going to be, it's a lot of gut, but it's positive or potentially signs that folks are going to be like perpetual searchers and be searching for businesses for many years and never actually buy businesses. So if I delineate the two of those from like a positive standpoint, right, like you can start with the real world domain experience. And I think these understanding how businesses operate, how if you have experience running teams, your financial knowledge, understanding how a P&L balance statement actually operate are going to be really important and key to either dive into or learn about a little bit more depth. And then there are a lot of folks that are willing to do whatever it takes to be successful. And I think that is very prevalent in the search process because they're adaptable, right? Like you kind of go through this, could be 6 months, could be a year, starting with finding a deal, talking to a broker, talking to the seller, offering on an LOI, and maybe going into diligence, and then the deal starts over. I think the folks that are successful are very adaptable throughout this process, and they keep iterating on what didn't work and what their learnings were from previous deals that they started. And I think generally speaking, that's a testament to how you're going to be actually operating a business, right? Are you going to continue to make the same mistakes a year or 2 years in and not achieve the results you're looking for? Or are you going to be able to find the problems, address those, and continue to adapt in that sense? So I think those are a couple of characteristics that are really big that we're looking for. And then from like a searching standpoint, having like a very deep relationship with the seller is so unbelievably critical. And I think a lot of folks think they do, but they're not always asking the right questions or understanding what the seller's feeling in the transaction process, right? Like really understanding what the seller ultimately cares about. And that can mean a lot of different things, right? It could be from, your plans operating the business, the transition plan, what the relationship is, down to like the economics, right? But I think defining those roles, responsibilities, and mapping it all out enables inevitably when you're in diligence, you're under LOI, you can make alterations, can retrade successfully. And folks that don't have that relationship, what happens is the deals fall apart because they need to increase seller finance another 5% to make the loan flow, right? Those type of things happen on almost every deal, it seems like. And the folks that have those relationships early on are able to get deals done versus folks that kind of bypass and are thinking about it from their perspective only. So those are all positive things. I don't know, John, you have a lot of thoughts on this.
Yeah, I want to ask Heather. Heather sees a lot of these deals and probably, throws a lot of the deals in the dumpster because they got to be a good operator and they got to be a good deal. What is a good deal to you? Because debt is a very large portion of the financial capital of the whole deal, right? It could be up to 90%. So you got to be a good operator and you got to have a good deal. What is not a good deal for?
Yeah.
Yeah.
Well, I think that most people think of a good deal and they start by thinking of the numbers. They start by thinking of the P&L and the debt coverage ratio and how the structure, the multiple that they're paying, how much seller debt. And while that is all really important, and we all, I think have different templates and ways we come at those numbers, there's a couple of things that are also, really, really important. And to your point, one of them is, what kind of operator will you be? Lenders are really, really keyed in on this one lately. Do you have industry experience? Most buyers don't. They don't have direct industry experience. So how do you present yourself as someone who has transferable experience? That's what the lenders call it. So you really have to look at every part of your background and bring that forth into a buyer profile that says why you're the right person for this company, not your regular plain generic resume. So you've got to have, sort of a document there, a profile, but you've really also just got to be able to sell your case, starting with me, but then ultimately to the lender, as to why you're a good fit, why you understand this industry, why you're excited about this business and see yourself as a great fit. It's not the easiest thing to do. So it's really, really important. It's kind of one of those intangible things. And then the next piece that's kind of overlooked a little too much, at least in the early stages, is all the non-financial characteristics of the business. Where are the risks? Where are the strengths? What is sort of the franchise value? And that should dictate the structure and the price a little bit. So I use a little method or a rubric that I call the non-financial scorecard. And I work with my clients to just kind of think through the top 10 characteristics and score them on a risk scale and weight them. And then let's talk about what that means. How much debt should you have? It's a high risk business. It should be low leverage. It's a really low risk business. Well, you might be paying a higher multiple because it's so good, but you could also take on a little more leverage. The ratio of leverage could be a little bit higher. So those are all the things that we look at. It's not just the numbers and the financials. It's you as an operator and your profile for that company. And then it's all the other elements of the business that aren't really captured in the financial statements as well.
Yeah. So let me ask Judd and Heather. So if I was just a couple extreme situations, never had e-commerce experience, and I came to you and said, yes, I'd like to buy this $9 million e-commerce company. 50% is FBA, 50% is through Shopify. Never had it before. I don't run an agency. I'm just like, I've just been working it as W-2. How would you score that? I'll go with Judd first, then Heather.
I mean, I would score it in a couple of senses. One is the likelihood of even winning a deal like that for how competitive it's going to be. Right. So from like my standpoint, it would be probably hesitant on spending a lot of time. And then second of all, I would be very keen on understanding what is their strategy of operating this business, who they're going to bring in for areas that they don't have clear understanding on, right? And then what skills do they have that are transferable in the first place? Because I've seen folks buy businesses, in healthcare, for example, that don't have any healthcare domain, but their advising team that's going to be operating on a weekly basis with them is incredible, right? So I think there are ways to get it done, but if you're going to go, hey, this looks attractive, I like XYZ, and I'm just interested in it, but you don't understand how these businesses operate, I think the likelihood of being successful are very low, and the likelihood of convincing anyone along the entire acquisition process is low. That's from the broker to the seller to the lender to investors. So I would grade it relatively low unless these other components are, really flushed out.
So having a good board surrounding yourself could help the story some.
It could help the story some, yeah. But I think from just like this is where you could go 2 questions, 3 questions deep on their understanding about how e-commerce businesses operate, from the supply chain to, bringing on customers and the, cost per click. And usually folks won't have answers to these type of questions. And that's a telltale sign that they actually don't know how they're going to operate these businesses. So I think it sometimes I don't like to dismiss folks, but a lot of times it's not thought out. And then therefore would be, a no-go.
Heather?
Yeah, I mean, there are certainly examples on the positive side. There are certainly examples that I have. I keep in touch with these folks, and they bought businesses that they did not have industry experience. But every industry is different, as to how hard it might be to approach that industry without experience. And to Judd's point, you need a team, you need other people to fill those gaps, to educate you, to be able to pick up the phone and call them. So if someone approaches in an industry they don't know anything about, and they don't have, advisors that do, and they can't create a business plan that demonstrates that they understand the business. I think that's like the third point. We ask for a business plan. We make sure we get a business and transition plan before we go to any lenders. And I like it to be short. It's not really an in-depth business plan. The purpose of this is really to make a first impression with the lender to show you understand the business. And I have an example of a client that initially was declined by a bank because of lack of industry experience. And I spoke with him, and he really did actually have some very good transferable experience, and he really did understand that business, but he hadn't done a great job in his business plan of showing that. So we coached him through redoing his business plan in his own words. We did not do it for him. We just showed him the points that he should probably put in there that he had told us already. Did a much better job the second go around. We went back to the same bank that had declined him, and they approved him. He closed the loan, and he's doing very well. So there's ways to overcome it, but it takes a lot of homework, and you're going to have to demonstrate to, whether it's the lender, your investor, the seller, you're going to be able to speak their language and demonstrate in almost every time you open your mouth that you do understand and you are serious. I think that's really important.
I think one more thing to add to that is you don't need to hit a home run on your first acquisition, right? Like, to go buy a $10 million business that you don't have any understanding of isn't necessary. Some of the most successful folks that I've seen in the SMB M&A space have started something significantly smaller, right? Like, go show and prove and learn and make the mistakes on a smaller case where there's not as much at stake. And then scale up. There's a few folks that I've already chatted with just from 6-8 months ago that started with, a smaller franchise, a smaller e-commerce business, and now are looking to, deploy into larger businesses. And every single time that they say, it's like, okay, if I would have gone and taken down this larger business right off the bat, it would have been really ill-advised, and I would have told myself I shouldn't have done that in the first place. But now, they're at the table and they're ready to go for, a larger acquisition. So it doesn't have to be, a one and done. This is put it all on the table the first to go. I think it can, waste a lot of time throughout the search.
All right. Let's go to part 2, or the next thing, which is, no, that's the wrong way. I got to get used to this Canva. Structuring deals. Now, this is Judd's going to talk about this, because structuring deals is, let's say you go find a business, you put an LOI on it, you're talking to Heather, she says, yes, we'll underwrite this for 90%, and because it's got a debt coverage service ratio of 1.5, which is great. Now you got to come up with $300,000, $500,000. How do you structure this deal for equity investors on MainShares to make this work?
Yeah. So, and this is going to be relevant if you end up working with us or not, right? So, like, we're not recreating the wheel with the way that these deals are being structured. And I think that's a common misconception. So the most common way an SMB deals can be structured from an equity perspective is, especially if there's leverage on the debt, will be preferred participating equity, which effectively means, try to simplify it down, is there's 2 share classes. Class A is the preferred equity, and that's all of the cash in for the acquisition. Your cash, investors' cash, right? And effectively how it works is the first money in, say it's $500,000, will get a coupon, a rate of return. Right now, where interest rates line up, 10 to 12% is pretty common. So after you pay the debt down, 12% of the 500,000 is going to go dollar for dollar for whoever put money into the deal. Then it's going to go down to paying back that $500,000. Right. So effectively, the way to think about it is the first money in is the first money that gets paid out plus 10 to 12%. And then after the invested capital has been paid out, one of the benefits of a preferred participating model for self-funded searchers is the economics after you pay back the initial principal on the capital is really attractive from a distribution standpoint. Right. So it's over a 10-year period. If it's just a buy and hold, for example, it's not uncommon for, even with a good amount of equity leverage, for 60 to 90% of the total amount of distributions the business provides is going to be going to the operator. Right. So that's probably the most common. And then for all equity deals, it's going to be more of it's called MOIC, so multiple on invested capital approach, where you effectively hit certain hurdle rates. So after I return the initial capital, all goes to investors. After I 2x, I'm getting a little bit of distributions. And the way that those are usually structured is you're not going to be getting, a lump sum large payment of these lower hurdles until an exit situation, most commonly, right? Because usually that's where investors are taking on almost all of the risk and therefore being compensated for. So that's probably the most common way these deals are being done. And I think then it comes down to, having realistic expectations for, return profiles, right? So from like a base case standpoint, like an IRR return of like 25% is kind of like the lowest entry point, right? Like realistically, after seeing more and more deals, it's not uncommon for an IRR, internal rate of return, to be in the 40-50% range on a 5-year basis. It's providing a 4x return to investors. So I think understanding what investors are seeing on a day-to-day basis, right? Because the way that we're set up is we have a large sample size of investors, kind of high net worth individuals to family office and everyone in between, right? So we have a good idea across the board of what folks are looking at when they're investing into the space in the first place. So having an understanding of, if you present a deal, they'll likely have other deals that they're, currently looking at, a limited amount of, deployable capital that they can put into these deals. So understanding what market rate returns are, I think is pretty key in making sure that you are structuring the deal to enable those, right? So flexing up or down the debt, the seller finance, that's where the return profiles can change quite a bit to make sure the entire deal pencils. So you got to basically model from 3 perspectives: yourself and what you want to take home from the lending standpoint, and then also from an investor side.
Yeah, let me ask you something, Judd, because a lot of what I'm seeing today is a lot of private equity, and some VCs are coming down in this market looking at this investing asset class. However, a lot of the guys that need to raise $300,000, $500,000 to close a deal don't understand the participating for the 2x step up and the 30% IRR, especially if they're trying to buy an HVAC company, 25-year-old HVAC company in Tucson, Arizona, that's only grown 5% a year for the last 10 years.
Mm-hmm.
How do you comport and bring those two together?
Yeah, so I think there's different strategies, right? And then different investors are going to be attracted to different strategies, right? The idea of being able to buy and invest into cash flow can be very attractive for a lot of folks because the return profiles are still high, right? So a business that's you're not going to be able to grow at 20% a year, I don't think is necessarily a bad situation for most investors, as long as the economics that you're coming in on and the price point that you're buying the business at makes sense, right? Where that becomes challenging, and this is kind of where it ties into private equity, is, a private equity firm that has a portfolio of 20 of these businesses, they can pay a higher multiple and they can basically allocate the cost across. you as an individual and an investor that's investing into an individual business, if it's being basically purchased at too high of a multiple, and there's not really an upside to be able to see a path of being able to grow fast, then that's where it becomes, challenging. And then the flip side is there's also a lot of strategies where, and there's plenty of investors that I've met that they don't care about distributions. They're not thinking about it on a quarterly, yearly basis where they want to see cash coming back to them. They're thinking about it from a 3, 5, 7, 10-year standpoint where they want to see every dollar being pumped back into the business in order to, 3, 4x the entire value of the business, and thinking about it from the exit side, right? So like, depending on your approach of operating the business, I think will also dictate the type of investors you will ultimately want to elicit and have conversations with, and making sure you understand what their outcome that they're looking to achieve is in line with what your overall strategy is. Because I sometimes think people miss the boat there, and they just think about IRR profiles and not overall strategy on both sides, your side.
Yeah, and I'll tell you, there's a lot of investors out there. You could have a real estate investor. You could have a doctor who's got excess cash flow. You could have a wealthy Facebook engineer because the stock price is up. So there's all kinds of high net worth individuals, accredited investors out there. I got a question from Houston. Are you seeing deals where investors are bought out at year 5 to 7 by the operator?
Yeah, so that's actually like a call option for operators is something that we're trying to create a standard around. Right. And I don't know if it's across the board terribly standard. I think a lot of times on a 5 to 7 year basis, most folks are looking for a liquidity event. From the way that we structure a lot of our deals, we'll have a call option the earliest a few years after the invested capital has been paid out. Otherwise, there's no upside for investors.
Yeah.
But yes,
just like make sure you tell her what a call option is. That's a
sorry.
right of the
call
investor.
option. Yeah, sorry. A call option is basically enables the operator the right to buy out the Class A shares from investors at a specific point in time. It can either be a time-based or after you've returned a certain amount of capital to an investor, then you have the ability to use the free cash flow of the business to start buying a percentage based and, ultimately owning, 100% over time. Or other folks look at it from the perspective of, I want to tap into, the investor funding, and maybe we're going to switch out some investors and we're going to bring in more capital to scale. But yes, we are seeing that is something that's being written in.
All right, I got a question from my friend Marlon Brooks. I'm guessing anything under 10% pref is low for investors currently. Is a 2x return the bar to start?
I would say under 10% right now is like 9% potentially. If it's at 8 or below, seemingly relatively low, especially for the self-funded leveraged deals. So I'd say 10% seems pretty standard right now, up to 12%. A 2x step up, so that's what the money in converts into, is a relatively good baseline. I don't think it always necessarily needs to be a 2x step up, but it is relatively standard.
And by the way, explain what that step up is a little bit more. It's like if I put 100,000, if the investor puts $100,000 in now, they're going to look for 2x that money in some sort of time period, right?
Yeah. So imagine you're buying $1 million business and $200,000 is coming in total equity. You put in 50,000, investors put in 150,000. There's a couple ways you could think about who owns what post-acquisition. One would be, okay, just looking at it from, you put in 50,000 over the full million, therefore you own 5%. Or you could look at it from the standpoint of an investor side that they put in 75% of all the equity that was needed to buy the business. Therefore, they own 75% of the business. Basically, what a step up does is it meets in the middle and it provides a sweetener for any invested capital that's coming into the deal. So instead of the 200,000 in total that converts into the million of 20%, we're going to say it's going to be 2x that amount. So it's going to convert into 40%. of the total deal. So basically meets in the middle and it sweetens the deal for any invested capital coming from yourself or from investors.
So I'll tell you a story. These are VC terms. This is what, a long time ago, we raised capital for a startup that I was working on, and these are the terms they look for. So they're looking for, a big, great exit, because when that step up comes up, they make a ton of money. All right, Jose Silva, is there a situation that the buyer acquired and established with no money out of pocket with MainShares, right, Jose?
Yes.
All right.
No money out of pocket. It's just not feasible. Just like a lender's looking for skin in the game, most investors are looking for meaningful skin in the game as well, right? Otherwise, there's just no risk attached, and if there's no risk, then alignment can be lost as soon as you hit the first hurdle. So I would say it's not too feasible.
Let me bring in Heather about that, because the SBA rules kind of changed around that. I don't know if any banks are currently doing it, but the rules seem to allow that, and how that comports with MainShares. Heather, you want to talk a little bit about that?
Yeah. So the rules were very surprising when they came out last year, where they took their 10% minimum equity and really effectively boiled it down to 0 within the SOP. So the SBA says if the seller will carry a note for 10% and it has at least 2 years of no payments, that will be the entire equity that a buyer could buy. Now, the SOP doesn't speak to what situations that might be appropriate and not appropriate in. That's what the lenders decide, right? And so what I tell people is there's really only I don't know of a single deal that's been done that way first. There might have been, but I don't know of any. And there might be 2 situations a lender would think that would be okay. One of them would be an inside buyer, somebody who built the business with the seller is, there's no transition risk because they're already running it, and the seller's giving them, a really fair price. So the multiple is low, and they just don't have any cash, and the seller's willing to help them out this way. Okay, a lender might go for that. That's a story they might do. And the other one would be a third-party buyer, not an insider, but someone who has a lot of real estate equity, but not a lot of cash, and says, look, instead of making me liquidate my real estate, could I just pledge it as collateral instead of, putting cash in and use the seller note? Maybe a lender would go for that. And that's skin in the game. So, no one's really going to get, other than maybe that inside person, a 0% down. I have had one lender go as low as 2.5% down, equity down, and the other 7.5% from investor, from the seller note. But whatever the equity piece of the pie is, I think the original question was, can all of that be from the investors and me, the personal guarantor, the operator of the business? None of it be from me? No, I agree with Judd. No bank likes that scenario. The SOP would allow it. There's nothing in there that says you couldn't, but from a skin in the game perspective, lenders don't like that either.
Gotcha.
And what I think is important to note is, yes, there are changes that enable, but like to Heather's point, the amount of times that it's going to happen are slim, right? So you might hear a story of, they didn't put any money in, but like banking off of that for your strategy, I think is like ill-advised, because in a lot of circumstances and deals, and Heather probably knows this more than I and seen it more, is like the amount of equity that has to come into the deal gets increased, right? There's a concentration of customers and more cash needs to come in. So like a lot of people think about it from like the bare amount that I need. Okay, let's move forward with that. And then they don't have a strategy if that is not the case. And then I think that's also what it has people finding great deals and not being able to execute on those deals, is because they don't have backup strategies and they're basically just maxed out on every single angle. So I think having alternative approaches to any deal is the angle they should be thinking about, versus like the minimum amount in. If everything goes right, this is feasible.
Yeah. So James got a question. Is there a sample waterfall that can be shared with respective hurdles under a typical structuring scenario? Class A pref, participating preferred, any catch-ups, common. So James definitely has a little experience with raising capital with investors, you can tell.
Yeah, we can get like a model post webinar sent out.
Yeah, great. I'll send that out. We have your email. Does anybody have any more questions? We're going to go on to number 3, engaging with these investors.
Could I ask a quick question?
Sure, James.
So Heather, you mentioned real estate, like your own personal real estate. If you had significant equity, right, in your own personal real estate, they might kind of be lenient on how much they'll accept. So if you're buying the real estate with the business and they're undervaluing it, let's say by significantly half, right? So because they just want to sell it with the business, does that also count? You know, does that make it more attractive from the bank? And does that also count maybe for them to be more lenient on what kind of equity you would bring in, or is it just strictly if it was your personal?
Yeah, they're really two different topics almost. Yes, lenders like real estate as collateral, but when you're buying the real estate and enterprise, obviously the whole loan is going to be undersecured because you have the enterprise portion that still doesn't have any collateral. And the real estate, that's not something you're bringing into the deal as equity. So what lenders really like that kind of sweetens the deal and brings skin in the game, makes them feel a lot safer, is an individual that has personal real estate and that has significant equity and that they will pledge. So they're kind of bringing an asset into the deal for the lender. That's something that they really like. Now, I don't want anyone to get the idea that if you don't have that real estate and you're trying to do a deal that's not going to have any real estate collateral, you can't get it done. You absolutely can. It's just that you're in a kind of a different layer of the risk spectrum. And you have a few fewer lenders to deal with. You know, some lenders just won't lend. Others will, but they will charge you probably a little bit higher interest rate, but you can still get it done.
Heather, I got a question here. I think you can answer. It's from John and his last name. Except the borrower is got a PG in a loan, which is personal guarantee, which is a financial. I've been through that. Yes, it's a financial proctology.
Yes, I saw that note. Actually, it's a really good point. So how does the lender look at, you know, when I say you don't have any skin in the game if you don't put cash in the lender's eyes, but what about my PG? You know, of course, that's a good question. And it's a very big piece of skin in the game. You're risking, you know, your entire financial future in a sense, because if the deal goes bad, there's going to be this, you know, offer and compromise where, you know, they're going to be going after your personal assets. So yes, absolutely. The lenders view that as skin in the game, and they really wouldn't do these loans without it because they'd be afraid that everybody would just toss back the keys the minute they had any kind of trouble. But they grade, you know, the value of the PG on a sliding scale of what net worth do you have. So some PGs are viewed a lot more important and valuable to the lender than others. They're all, like, from a personal level, they're all very important in driving behavior. If you ask a lender, they would say that they're all equal in driving good behavior as far as trying to make the deal work, trying to make the payments. But as far as the value upon liquidation, or, you know, can this person put more cash in if the business was in trouble, et cetera, they're going to view someone with more real estate collateral and net worth as a more valuable PG than someone without those things.
Yeah, by the way, I'll tell you the story here. I was trying to buy a portfolio of courses from Udemy, was throwing off $2 million a year, 90% profit margins. And the bank that I used at the time, I didn't have the network that they were looking for. So I just called up a buddy of mine and he goes, "Hey, how would you like to be CEO or chairman and put up your net worth to this business?" And I came on and they wrote the loan for 1.7. So that's how I solved it.
There you go.
Yeah. Sean Tag, could anyone provide a sample business plan, or someone could give me a guidance on my business plan? And I'm currently writing one. I'm under LOI, and I think Heather can handle that.
I do that. So if you come through me for the debt raise, that is part of our service. We don't give a template, and I'll tell you why. I very specifically don't want lenders to pick up all my deals and say, Heather wrote these business plans or Viso wrote these business plans, right? I don't want that. And I wouldn't do that. And so I want them always to be the format that you like and always your own words, but I will coach you. I'll tell you how long it needs to be. It needs to be short, by the way, for lenders. They will not read it. I've had some beautiful business plans that had every detail possible, and all the banks did was ask the questions that were already answered in the business plan, which meant they didn't read it. But so keep it short. Keep it about the people transition and why you're a good fit. You know, we would be happy to coach you through the rest. Once we get to know the deal, there's always some nuance that I can point out and say, you know, a lender's probably going to want you to talk more about this or bring in this to your discussion, but it does need to be pretty succinct. That's my main piece of advice.
Yeah. Sean, I could actually help you with that also, because I used to do pitch decks and raise capital for CF and Reg A's and 506C campaign. So I've been in that. Judd, Ron Wexler has a question. When MainShares provide equity for an investment, can you talk about how much equity you are putting into the deal, max, min, average, and commensurately how much common equity the investors get as a result?
Yeah, I was about to jump in on this. So MainShares is not putting in equity into deals. We're facilitating the process of raising capital from investors. So I think this is a common misconception. We're not telling you, hey, we have an investor pool and these are the folks you have to work with. These are the ones that are going to be sitting on the cap table for a long time, right? This is all directed on your side, right? We help the process of making sure you have the data room that with the information that investors are looking for, the pitch deck, the model, the pro forma, the investment docs, everything that's necessary, and then get you in front of the right folks. But then ultimately, you have full dictation over the terms that you're going to market with. You know, we provide guidance on, you know, what market is and ultimately who you're going to be working with. So this is going to vary as far as minimum and maximum. The amount of cash that's put in on a per check basis, because these are all deal by deal and, you know, multiple investors, generally speaking, especially because of the SBA. Minimum check size to be on MainShares is 25,000, scaling up to $1 million is probably on the highest end of individual check that's being written. I would say there's probably consolidation around $100,000 of a per check per investor is where we're seeing like a bulk of individuals that are cutting. And then the amount that is given up, this is all depending on the deal. And it goes back to, generally speaking, the amount of distribution. So an actual cash flow that goes out to investors could be anywhere between 40 and 10 and 40% over the life cycle of the investment. So it could be 20%. I think that's usually pretty common.
So Judd, I'm going to kind of read through this, unpack this. What it looks like is the difference between somebody that's just coming into giving away or selling equity in this acquisition to somebody that's like a startup in Silicon Valley and it's his third startup and he goes, hey, this is what we're offering right here. And you can buy it or not buy it, but this is what we're offering on these terms.
Correct. Yeah, I mean, that's what all of it, everything that you would be going to market with, you would at least directionally understand exact payouts to yourself, to investors, and everyone in between. Right. So as long as the business continues to, and usually you have base cases, bear cases, and then also, you know, if you hit, you know, home runs, what is the outcomes? So all of that is, you know, pre-negotiated, pre-written out, and then you go to market with those terms to solicit, you know, investments.
Judd, I got a question from Joseph. Can this work for someone abroad, not a U.S. citizen that wants to buy a business in the United States?
This is where it gets a little bit more challenging. It's gonna depend on where it's at. But since we're facilitating the actual private placement, there can be some issues internationally where we're not registered. So this is, you know, Canada. We've figured out routes there, but generally speaking, no. Otherwise, we have to learn the specific security laws in each of these areas, which brings on outside counsel and it becomes a nightmare.
got a question from James. That's a ditto on another same one. Anthony had a question, I think kind of directed at you, Heather. Are Rob's deals common for equity injection? Or Judd?
Yeah, I would say they're not that common. I actually answered it in the chat. I'd say less than 10% of the time, I see people using Rob's. What do you think, Judd?
I don't see, I see people saying they're planning on doing it, but then not doing it after, we started chatting, because then they have, other options not to liquidate all of their holdings. So uncommon.
All right, so I'm gonna answer this one more question from, or ask this question from Houston, and then we're gonna go on to the next section, which is engaging with investors. So Houston has a question. For someone with a low net worth, what percentage of purchase price generally does a buyer need to put down himself, herself, or bank and investors to get comfortable with the skin in the game topic?
Yeah. I mean, from like a lending standpoint, we've obviously seen lower amounts. Usually from a lot of like the lending partners, it's under 2.5%, then it becomes a question of meaningful amount. From our perspective, and Heather probably has more insight there. From our perspective, I think of the total amount of equity on the lower end that you need to raise in total, like 20% is kind of a good benchmark as a starting point. And then I think a lot of folks will be coming in with, 30 to 50% and then raising the rest. But this is really depictive and off of like the individual. If someone's coming in with a very minimal amount, but has a great business, a great strategy, and they're just not very liquid at the moment, I think it's totally feasible, but it starts to question the commitment, right? And I've just got off the phone with two investors today that they see that this individual has had jobs, VP jobs at Google, and they're putting in $15,000 into the deal, raising $700,000, $800,000, right? There's not a big story there. And I think that's a red flag, right? But we'll usually work on a case-by-case basis to figure out what makes sense.
All right. Judd, I think Marlon Brooks has a question. Is there a seasoning requirement on the money? And if so, how long? Hey, Marlon, why don't you come on and explain that seasoning requirement?
Yeah, I was just wondering, the money that's used for the down payment, or any requirement on that, how long it has to be in an account sitting, or that's my question.
I think it's more of a lending question, right, Judd? You don't have any special requirements on your end, or do you?
No, it's whatever the lender.
Yeah, so it's a lending question, Marlon, and it's really funny because I've done both SBA and non-SBA acquisition lending, and in the non-SBA world, this is not a thing because everyone views cash as fungible, and it's like water. How do we know where it came from, really? But in SBA, the SBA has a requirement for seasoning, they call it, and they just shortened it. It used to be 60 days prior to close. You had to have it in one account. All your investors had to show those account statements for 2 months worth prior to close. And they just last fall changed it to 1 month. But it's something that's collected at the very end by the closer. And they take it all the way down to the day. They take it very literally that they have 30 days where they're showing that cash was sitting in an account for at least 30 days prior to close.
Okay. Thanks, Heather.
Yeah,
All
and
right,
it needs
Judd.
to be in the US, I should say, during those 30 days.
All right, Judd, we're going to go to the next. Engaging with investors. So I got this great deal. It's a $5 million business. I got a loan from Heather. I got a, underwriting said they'd do it, maybe 80%. And now I got to bring in, $1 million to do this. And there's some seller note. Okay. How do I gauge? I put this off. I got a good business plan. I talk to you and how do I put this offer on MainShares? And then what happens next? Does everybody just start like fish chumming or what?
Yeah. And I do want to make like one comment about like pre-LOI, and then I'll jump into your question. So I would say just in general, raising capital is challenging, right? and relationships take time and like trust is earned, right? So like if you think about just the process of this buying a business, if it takes 6 months, takes a year, I would start developing relationships with any individual that invests into the space as early as possible, right? So like staying in touch with them throughout the search process, I think is critical. And if you think about just like the time horizon that you have to convince someone to give you $50,000, $100,000, $200,000, it's relatively short. There's things that we try to do to streamline that process, but if you're able to keep in touch on a monthly basis, and some things you could do easily would be, highlighting deals that you find interesting, tell them why it's attractive, red flags that you're seeing in these industries, how you're going to potentially like mitigate against them, show them how you're thinking about your diligence and deals. So when you do bring a deal that you're like, we're ready to raise on, they have an understanding of like who you are, your attributes of being successful, and what you've done already to like diligence these deals, positive, negative learnings, the team that you're building together. And there's a lot of ways you can stay in touch. And then when it's time to ask for the big ask, you've already built a relationship and built some trust. So I think starting there is pretty key. And I think there's Search Funder, there's a lot of resources where you can just start having those conversations to understand how to conduct them. And then when the deal is actually under contract, right? I think there's a lot of folks that have invested into acquisitions and they understand the process of LOI to close. And then there's a lot of folks that you'll meet that are interested in this. Maybe they ran a healthcare company, a construction business, and they like you and they want to see you succeed and purchase a business as well. But what I think sometimes people don't understand on the investor side is what is the process, and being able to give them a timeline and the process for the acquisition, I think is pretty critical. And what you can do is, talk through the personal diligence, the QOV, then I receive the term sheet, finalize my QOV, create the pro forma. Now we're going to be accepting commitments under this time horizon, and this is how long I have until we're going to kick off the SBA. Right? So like map out what the process looks like. I just got off of a call recently where first time investor into the space didn't understand why terms weren't finalized because the term sheet wasn't there yet, right? Like you can have those conversations, but you just have to educate them. Things change, and this is how it works, and then set the stage for when I come forward with the final offering. This is how much time I'm going to have to accept commitments and make a decision on who I'm ultimately going to work with. And during this QOV process, this is when you're building trust too, right? Like your expectations from a seller standpoint is to tell you when there are good, bad, and ugly situations with a business. Investors expect the same thing. And they're also like, you don't need to shield them from, bad, learnings that you have about the business. I think sharing what you're learning throughout, because you realistically uncover a lot when you're under contract, and how you're going to mitigate against those is going to help build confidence. And it's all momentum build into, finally, asking for the check and asking for the partnership. So I think there's like a couple stages. One is build as many relationships as you can up front. And then once you're under contract, start setting the stage of how this works and the progress along the way. And then ultimately have all your ducks in a row of, I have a great conversation. Let's use the momentum to make sure that we have the investment docs set up, right? Someone's interested, they want to invest. How can we move them from I'm interested to signing a commitment letter to invest into the business? Making sure you have all of that sorted, I think, is pretty key as well.
So if let's say if I'm raising $500,000 and I get interest, $100,000 minimum and 5 people, do I have this conversation in a webinar with everyone, or is it one-on-one?
Yeah. So I think the way to think about it is hold like try to have like a pretty streamlined approach and keep repeating that and iterating on it with investors, right? So like you start out more high level, especially if it's the first time you're meeting them, right? this is me, this is the opportunity, these are the tailwinds. And then after those conversations, you're usually sharing some more information that they can dive into, right? This is your maybe more in-depth pitch deck. If they've only seen a teaser, this is the diligence, documents. And then, it's usually multiple conversations. Most folks aren't meeting someone for the first time and cutting $100,000 check just by looking at the deck and the model, just like a bank isn't underwriting and providing, millions of dollars just based off of, the financials. So then from there, I think a couple calls after to really dive in and ask the tough questions. What might be causing them hesitation and understanding, tailwinds or potentially red flags, because I think a lot of times people assume get happy years and then kind of circle back and the investor doesn't make a decision to move forward. We have a conversation with them and it was because of X, Y, and Z. And the operator actually solved for those things, but they didn't bring it up in discussions. So I think being able to have a refined process of, starting more high level and then getting progressively deeper into the tailwinds and the red flags and the details about how you're going to operate the business, and then holding to that timeline that you already previously set will help you, move people either through and completed, or maybe they're not the right option and they're not a good partner for you.
Let me ask a question about this. So if I'm just I was a W-2 for 10 years, want to buy my own HVAC company, are you coaching me on these calls with these investors, or how do I know what to say and offer or respond?
Yeah, I mean, we have like two different offerings there. One of them is going to be much more hands-on. A lot of times for folks that have not raised capital before, and vice versa, the other is just more of a vehicle and introductions to investors. So depending on kind of like the route, yes, we absolutely provide support and continuously like iterate on the way that they're presenting it, the information that's being presented, because sometimes, especially for maybe niche industries, the approach needs to be a little bit different for folks that don't know about said industry.
All right. So let's talk about some ongoing touch points, like highlights on the deals, what they're looking. What qualities of the deal make it attractive to investors?
John, I'm sorry. I just wanted to say goodbye before I leave. I have to go for another call, unfortunately.
Heather, thanks so much for showing up, Heather.
Yeah, thank you, everybody. Bye-bye.
Yeah, I mean, I think you don't have to overcomplicate this one. It's a similar reasons why you think it's a good business, why you think you're going to be able to make great returns, right? So similar to the flow of what lenders are looking for, is a lot of times what investors are also looking for, because the outcome that everyone is looking for is success.
Let's make money.
Business, make money, right? Like, so I think there's, and then it kind of depending on what the investor's ultimately looking to, if it's return profiles, distributions, that kind of goes into the strategy a little bit. But then industries do come into play a little bit, I would say a little bit more, where people will spend time talking to folks that know nothing about the industry, and it can be, time wasted. So finding alignment with investors that understand the industry from a high level, maybe it takes some education and they're willing to invest in an area they're not familiar with or not, right? And if they're not, then it's, time to move on.
Yeah, what about red flags do I need to be transparent about these up front, or am I going to wait for those and give them the presentation? And how do I know I think is a red flag, they see a red flag or not?
Yeah, I mean, most of the decks that we have will have all of the risks that are either figured out through diligence, through the lender, and then mitigants on also. So I think bringing it front and center is critical, because they're going to be, especially Sharp Capital is going to be looking for, okay, it's not this business obviously has some issues. Every business has some hair on it. And bringing that front and center, I think will show them that you have run the paces on diligence, you understand the business, and you have a strategy to mitigate against those. So I think it's always prudent to have any red flags front and center, because ultimately, if you don't have any, it's a red flag from an investor standpoint. Or second, they're going to see them and then realize that you haven't noticed this yet. And you have no strategy to mitigate against this red flag. So I think it's always prudent to have it.
Yeah. What happens if I'm buying an HVAC company, it's a good deal. And then I get this Facebook engineer that doesn't really know anything about HVAC and what makes the bell ring. Have you had that before?
Have I had that before?
Yeah.
I would say most of the times folks are going to have where we're at right now in our life cycle. It's mostly individuals that I've worked with personally that have domain experience, but a lot of individuals that I've met that have acquired and own businesses are coming from more corporate, non-transferable positions and are still successful. So I don't think you necessarily need to. And they have also raised capital from investors. So I think it's more situationally based, but yes, absolutely. 70% of acquisitions are first-time buyers. A lot of those individuals are first-time operators. These are different industries that they potentially don't have a lot of knowledge in. So yeah, I think it's totally.
Yeah. Can you tell me about the process of closing? How you're asking these buyers to close on the deal, like asking for the money? How do you do that?
The investors?
Yeah. How do you? I'm talking to you, Judd, and I go, hey, look, Judd, you've seen my presentation. It's a good deal. Are you in? Or are you out?
Yeah, I mean, I think this is where like setting the stage on like just the expectations on the timeline, right? These are deals that have a finite amount of time until it's either going to happen or it's not going to happen, right? So setting the stage there implicitly is going to say, here's when a decision needs to be made. And then you can get ahead of the 8 ball of what needs to happen and to enable you to make a decision on this. But then ultimately, yes, there's an ask of, okay, we're accepting commitments, finalizing the cap table. Here are the offering docs. And are we ready to go? Yeah, absolutely.
I have a question related. So what is the dynamic if you have the equity injection and you have a deal structured in such a way and you've got a lender on board and you really don't need investors, right? But you would like some value add investors, right? So people who are in the industry or have experience, let's say you already have experience, but it's people who can help you with certain aspects that you want to grow the business. For example, let's say e-com, they're direct to consumer and you want wholesale, right? Or to go to retail so is it the same dynamic? Are the terms kind of the same, where if you don't need the money, but it's like a nice to have money, you know what I mean? Like, are you expected? I don't know the right word I'm trying to get out here, but have you seen that, or is it primarily people trying to get equity or money to get the deal done, right? Like they need it, otherwise they're not gonna be able to close on this deal versus just positioning yourself better, for the growth.
Yeah, absolutely. I mean, it's a great question because some folks, they only care about cash in and cash out, looking for passive investors. Others are looking for strategic capital. I would say, yeah, the relationship is definitely different for when I talk to like more strategic capital partners that are going to be involved past writing the check, right? So there's usually, there's a time commitment associated with it, which then could have, side letters attached to have more upside and more alignment in the upside. I think that's a very fair and generally pretty common case. If it's going to be more than I'm going to cut you a check for $100,000 versus I'm going to cut you a check for $100,000 and going to work with you 5 hours a week, introduce you to the, my connections, my ecosystem, I think there's a little bit of a difference. But also, like, there's a lot of people we chat with that could buy the businesses unless, if they find a couple people or a couple entities that would be able to provide value into, being able to loop those folks in at close is also an approach as well.
And so so that makes sense, right? Because you're going to be asking their time as well, not just their money. Their time and their knowledge and their advisory, et cetera. So is that typically tied to, in your experience, like a higher step up? So like a larger, a larger percentage at conversion, or is it a larger preferred equity, or is it just a flat fee per for their time, right? How do you typically see that, or is it just so variable?
It's variable because you're a market taker versus like setting the market. Right. So like usually these deals that we're helping set up are going to be, we're setting the terms and we're looking for investors that want to invest in said terms. On the flip side, this is where it's almost, more commonly in like lower middle market is you're taking the terms from an investor. And I think that's more common with, strategic capital. And
what they want versus what you're offering. Right.
Exactly. Right. So it's like I talked to old operator just sold his business for like $50 million. And he's going to partner with a couple of folks that are in, light manufacturing. The relationship that he's going to have on an ongoing basis, is a lot, right? 20 hours a week, basically in a partnership standpoint. So you're going to see like a much higher ownership percentage, and they're effectively like partnering together with the capital coming alongside. So it could be royalties, it could be hours, likely going to be higher ownership to make sure that there's alignment in upside for providing, the support.
Gotcha. Because it's probably not going to be the first time they've done something like this either. So they're going to know what they want generally, I would assume, right?
But yeah.
Well, guys like that, I'm going to jump in. Guys like that, you want on your board. Let's say, I've got a networking company. It's doing a couple million a year, and I know John Chambers from Cisco. Do I want him on my board because he's going to open doors? Absolutely. What am I going to give him? 5%, 4%? Absolutely. Because this is going to be $100 million company in a very short period of time because he's going to open doors.
Gotcha. Yeah. So you got to be thinking forward, right?
Yeah.
You got to think about the future value of what they can bring. Okay, that's appreciated. So I was thinking of it from the opposite, but that makes complete sense because they're not just giving you money, right? And even though you don't need the money, their time is going to kind of
it's worth a lot.
It's worth a lot more money, right?
Yeah. All right. So, Judd, did we get everything about the engaging with investors? Because we're going to go on number 4, which is the raising capital part.
Yeah, and we started chatting through that, but yeah, let's jump in.
So what do we need to be aware of? The whole process, how long this takes, et cetera, what, time it's going to require of me, somebody buying a company, et cetera.
Yeah. So from a time standpoint for a lot of these deals, there's a couple things to think about. Is you're under exclusivity for 90 days. Lending, underwriting can be 45 days easily. And lenders are generally not going to start to underwrite a deal until the cap table is pretty much finalized. Right. Sometimes it's just commitments towards the total amount, but they basically want to know, okay, if we underwrite this deal, our success rate is 95%. Will you have the money in order to close? Right. So when you back into those numbers, you're looking at maybe like a month and a half post close to finalize the cap table in a lot of circumstances if you're running it, smoothly. So six weeks is kind of like the time horizon. What you need to have and be ready for is starting with the data room, which you're already collecting in diligence, right? And ensuring, and a lot of the similar information that you're providing for the lender, and then you're requesting, you're going to have that structured to share with investors as well. Then it's from a modeling standpoint, I think the big situations are to have this back, flushed out would be your base case, your bull case, and your bear case with rationale on each of these situations, which then ties into your business plan and your strategy. And then wrapped up with the pitch deck and an investment teaser. So all of those things I think need to be sorted out really quickly. And usually when we're working with someone, that's right after the LOI, we're kicking off all of those items. And then there's legal and compliance components that go into any type of, legitimate capital raise where there are, for our standpoint, we handle all of those, but there's a lot of players out there that can help with like the investor accreditations, the KYC, the AML, bad actor checks, Form D, blue sky filings. There's some regulatory filings, so like lien on counsel, to understand what is necessary and at what point in time. But generally speaking, before an investor is able to invest into the deal, you have to have your investment docs prepared. So that's your subscription agreement, your operating agreement, and your equity commitment letters. Have those lined up, have the terms match against the model that you're sharing, and then a process for investors to credit that they're accredited investors, because these are private placements that are regulated by the SEC. So most of these deals, the way that they're set up is they need to be accredited investors. So what's the process to prove that these investors are accredited? And then from there, it's, a couple of final pieces of what I mentioned. It's Form D and blue sky filings are the most common. That's after you have closed the round, called the capital, that you would file with the SEC.
What about the private placement memorandum subscription agreement? By the way,
Yeah.
if you're raising money, selling securities, you gotta you gotta fall in line with what the SEC requires. And every company that's selling securities has to have a private placement memorandum and a subscription agreement.
So private placement is actually necessary for 506B, which enables you to take on non-accredited investors, but it also doesn't enable you to solicit the deal to individuals you don't know. Right. So the idea is, if I have 5 friends that I know that are not accredited, that I'm not going to be reaching out to people I don't know, then that's when a private placement memorandum is necessary. And it's also common in larger capital raises for larger deals. For the way we're structured, the 506C is a private placement memorandum is not necessary, but accreditation of those investors is a necessary item. So yeah, definitely lean on counsel that understands the SEC and private placements. But looks like we got some questions, so I'll stop there.
Yeah, all right. So that's raising capital number 4. So folks, we're at 12:16. And I said this go to about 12:30. So I'm gonna open up Q&A. Completely open it up. If you have any questions, let's
Yeah, I got a question again. So my question would be, so you mentioned private placement versus accredited investor. So what is the qualification for knowing someone? Right. So what does that mean? You can't publicly solicit someone, but if you have a friend who knows a friend, does that, or a friend that knows a friend that knows a friend? So where does that fall off, I guess, right?
6 degrees of separation kind of.
Yeah. Is there a clear line there? As far as you personally yourself, so if I'm raising capital or I'm looking for investors, I just can't publicly post saying something, but I could ask my friends to ask if they know anybody, or if they know anybody, and then that's not the same thing as private placement versus having to be accredited, basically, or having to accept money from a accredited investor specifically.
I mean, at that point in time, you're definitely taking on more risk.
Right.
It's not through I believe I don't know, we don't do a lot of 506Bs, but there is a time period of knowing the individual and protocols around it. I'm not going to talk on the specifics. I'm sure there's an entire chapter on this section, but it is the idea of, previous relationships with the individual and going to those folks and no one else. So it
That makes
does
sense.
limit you in the entire approach. And it's more common for individuals that have raised capital from the same people and they keep, going back to those individuals.
Yeah.
Awesome.
By the way, I think you should say expectations. The reason that the SEC was brought in when you're selling securities is there is always going to be a shareholder possible lawsuit, a complaining investor, like the guy that just sued Tesla. He only had 9 shares because he didn't like Elon's comp pack.
Got paid too much. Yeah,
Got
they
paid
paid
too
him too much. He made everybody too much money. So therefore, yeah, I saw
I'm
that.
gonna sue. Yeah. So
Crazy.
there will always be that. That's why you have to, definitely represent your offer clearly, transparently, everything. Right.
Appreciate
All right. Jose, you had a question.
Yes. At what point do you provide a proof of funds letter? Is it early on when the seller is requesting it?
Yeah. So from a proof of funds standpoint, the way that this works is we will basically, for folks that we, engage with and we decide that we're going to help the capital raise in some capacity, right? So if it's through our broker dealer, if it's through, just the acquisition vehicle arm and our investor community, our broker dealer will basically diligence the deal with the information that's provided. So pre-LOI, it's usually pretty lightweight. But at that point in time, they can write a letter of support for specific entrepreneurs and specific deals to provide for a broker or for a seller to be able to break through the proof of funds issue, which generally has a relatively high success rate.
Cool.
Thank
All
you.
right. Any other questions here? While we've got him on for another 10 minutes, Judd, doing fantastic, man. Open it up, guys. This is your chance. Now, by the way, if you decide this is the way I want to go and I want to talk to Judd, you got to they're doing some tracking here to see how valuable this was and helpful it was. So go to mainshares.com/r/Jon, Jon. Any other questions while we've got him for another 9 minutes?
Sure, I'll throw another one out there. So I have a deal specifically that I have an IOI out on, and we're kind of agreed in principle. I'm expecting a counter from him before we do like a formal LOI. So again, this is a situation where I don't need investors for this deal, but I want investors for this deal. So do you guys have strategic investors, or is that just a separate conversation, or the primary investors on MainShares, just passive check investors, not interested kind of?
Yeah. So first of all, the network is growing really quick as we're starting to get some inventory and some good deals and good operators. So already, the first couple are getting kicked off and the pipeline is looking solid. So it's starting to expand quite a bit. Honestly, my calendar is hardly available anymore talking to new investors coming in. I would say that over half are going to be like non-passive investors in some capacity. The length of how strategic they are is harder to gauge without understanding specifically what they want to do with each investment, because they do have strategic arms and they sometimes, it's like most venture capitalists, they provide a lot of value, but sometimes it's just a check. So I would say that, yes, there's a good amount, and there's also probably like 30% are operators, currently operating businesses or sold businesses recently that are looking to allocate and help from an advisory standpoint. So there's a good amount there. And I think that's what we really want to tap into, is working with, more operators that have had successful exits, continuously are buying businesses to bring to the platform.
And so I appreciate it. So from my perspective, I'm expecting, again, like so as far as submitting like a deal pre-qual on MainShares, right? And getting matched with, or having that, I don't know the process from there. I don't know if it gets submitted to investors and then they kind of look at it and express their interest. So since I'm not under LOI, is it better now? Should I wait until I, get it countersigned? When is the best time to kind of start that? So just, with you guys, is it before LOI or is it like, should I wait, not waste anybody's time,
Pre-LOI, it's more on strategy to win the deal and structure on the deal. The introductions, that just because a lot of deals fall through, it doesn't make a lot of sense to continuously send pre-LOI deals to the investor base. And I think in general, like there's a lot of investors that don't want to see deals before they're under contract.
That was
So
my
I'd say,
experience, yeah.
yeah, it's like some care, most don't. So after a deal is under contract is usually when we're gonna go start setting up, the investment opportunity on MainShares, and then start to send it out to folks that, are relevant. If that's check sizes, if that's strategic capital, like who do you want to see the deal in the first place? Which then ultimately, leads to, introductions and calls that entrepreneurs are running.
And I'm assuming that are you baking extra time into your LOI to kind of facilitate this? Or do you, since obviously I don't know, you said we got to have multiple meetings with these people, et cetera, et cetera. So it's like, do I try to bake more time into, let's say, an exclusivity period to account for that? Or am I upfront that, hey, I'm raising capital for this deal, or do I keep that veiled behind the curtains, I guess?
Yeah. I mean, if you have the money versus you have to convince people to give you the money, it's always going to add more time. MainShares are not, right? That's
Yeah.
capital raise. But yeah, I would say, giving yourself 90 days versus, 45, 60 days is probably pretty prudent. That would be even if you were, not raising capital. I'd say like, so there are plenty of circumstances where like time is of essence and it'll help you win the deal. And then if you're able to kick back and it takes longer to, ultimately convince individuals to invest into you, right? That's, more up to the operator. As far as like being upfront that you are raising capital or not, I would say it's going to come out likely. I mean, if you have the money to buy the business and it's an option to bring in investors, I don't think it's necessary to say, hey, I'm raising money. Versus if you have only 20% of the capital needed and you will have to raise money from investors, like it'll be known because the lenders won't be kicking off the process, be asking for the cap table. So you might as well get ahead of it and then just be like clear on your process of being able to successfully do so. Which sometimes, our letters of support can be helpful, sharing some traction with, high level, individuals of potential check sizes that are more soft committed is a strategy a lot of people do, of saying like CEO of healthcare company, $100,000, and start building out like a preliminary cap table of soft commits and then sharing that with a seller or broker is something I've seen being successful to show that, you have a path towards raising the necessary money.
You're not winging it. Yeah. Okay.
Hey, James, the point is, you've heard the statement, raise the money when you don't need it. That doesn't mean that they're going to give you the money, but you're telling a story that, hey, I got a success story happening. You better get on it. You're creating that FOMO because the next deal you come on, they're going to go, hey, James, what do you got going? Right?
Yeah.
They're
Absolutely.
It changes them from you reaching out to them, fishing for them, to they're turning around fishing with you. Right?
Absolutely. Yeah. I appreciate it. Thank you.
All right, Jose.
Hey, John. Yeah, I have another question. One of your earlier podcasts with Heather, she emphasized the high probability of getting awarded a SBA loan when the establishment is nearby where you're located. So, is there like a radius for that to occur? Is it 100 miles, 200 miles? I'm just curious.
So you're asking is the probability of getting a loan underwritten by a bank improve because you're closer?
That's correct.
I would say I don't think there's any association there because the business that I had got a loan on was in England.
Oh, okay. Understand. Thank you.
Cool. I got a question from Mike. I know you talked about this a little bit. What range of company equity can I expect to give up to an investor? Example, $5 million deal, 5 multiple, lender wants 10% equity down, so 500K. I put in 100K in, so need 400K from investor. Judd?
Yeah. So 20% down, 80% in. At a 5x.
First of all, I got a question. I got to make sure you're looking at this deal. What kind of company gets a 5x multiple? Mike, you want to come on?
Yeah, the 5x multiple is gonna basically mean that you're gonna probably have to give up more, especially because $5 million deal, that means your cash flow is only $1 million. So if it was like a $5 million cash flow business, multiples or 3 million like the multiples increase. So I would say in this circumstance, the return profiles, if you gave up 20%, probably wouldn't be terribly favorable. If you gave up 30% of cash flow, you'd probably be getting closer, be like 25. But it's pretty hard to say without running a model.
Yeah. Mike, why don't you tell us a little bit more about the business?
I think
you don't have to tell us the name. You don't.
I don't think he's talking about an example. I think that he's basically just giving an example here, 5%, 5x. But he's basically saying that he's got to bring in investors that are going to put up 8% of the 10%, right? So he's probably going to have to give up what, 16%? A 2x step up on average, something like that. I think that's what he was getting at. I didn't want to cut him off. He wants to come up here, but
yeah. I just wanted to get a rough idea. This isn't a specific example, but it's I guess it would be in healthcare. That's the industry I'm looking at. So something like this is definitely at this multiple, at this $1 million in EBITDA is definitely something fairly typical.
Okay. Yeah.
So I just wanted to get like an estimate of a range that I can expect to give up in equity for the transaction. And I know there's different structures and whatnot, but
yeah, I would say around because if you just do the 2x step up, then it would be 16%. But they're also going to be getting a preferred return on the majority of the amount of capital coming in. So like total distributions over the life cycle of the business could be closer to 20 to 25%. But ownership will be a little bit different. It'll be closer to that 16%. But obviously,
okay, that's helpful. That makes sense. And then I guess we would just have to make sure that the debt coverage ratio is high enough with that distribution being given out to the investor.
And the distribution happens after you pay the loan.
Okay.
So because the lenders will never let any money go out the door until they get paid first. So it's all leverage free cash flow.
Got it. Okay. Yeah, that's really helpful. That makes sense.
And last thing is, Mike, is there's usually like a peg for excess capital that's needed to operate the business. So say it's $100,000 that's needed to operate the business healthily. Any dollar below that amount, there'd be no distributions. Any dollar above, then you have the ability to either distribute the capital back or potentially like reinvest into the business. And then that depends on your relationship and like the rules that you've set with your investors of how you actually go about that. That's usually how it works, is there's like a peg of the amount of capital that's needed to operate, because you're not going to wipe the bank account as soon at the end of every year, of course.
Mm-hmm. That makes sense.
Mike, did you already run the numbers with SBA what a $5 million or 90% levered up loan would look like on $1 million EBITDA?
Yeah, I mean, I ran some numbers, definitely, and I know you sent out a sheet an email with a sheet, maybe last year. It was a while ago, and that's kind of what I use. But obviously, I updated it and I put things in there, and I anticipate that it'll also be with some rollover equity from the seller. So, yeah, and then I guess there's just a number of ways you can structure a deal. So,
Totally.
but yes, I'm looking into that.
Yeah, it's Judd's correct on that. I mean, the SBA is kind of like they'll provide guardrails, what you know, max they are going to pay a multiple on a business and what they'll you know, write the loan at or pencil the loan at. So you kind of got to see what they're going to do with that.
Mm-hmm.
Yeah. All right. We are at 12:33. Judd, if you guys have any last questions, David needs to leave. And
I had a last one.
Marlon Brooks.
I got a
Buddy.
couple parts.
What's up,
Hey.
man?
Hey, just a question. As far as like closing costs, due diligence, are you expected to bring money for that, or is that part of the raise? And do some of the investors, do they have their own due diligence teams? Some of the investors that maybe they can, you know, help with that if they're involved.
Good
And
question.
yeah.
Yeah.
And also one more, are they restricted or like excluded industries that you don't work with in MainShares? So
Okay. So first question was the additional costs. So transaction costs around like legal can sometimes be paid up front, but then it's paid into like the equity. So if you paid $20,000 to legal or QOV, that's usually rolled into the equity amount that your contribution. So that's relatively common. Closing cost for loan is paid out of the uses of the funds at close. So there's usually like, and some attorneys will also only charge at close, but plenty will charge up front. Same with quality of earnings. So those are usually like out-of-pocket expenditures, but then they'll be used. Say you spent $30,000, so it'll be counted towards your equity in on the deal. Second question was, can you do that one more time?
oh, if some of the investors have their own due diligence team,
Oh yeah,
and if they're involved.
yeah. So they're gonna, yeah. I mean, almost. It's just like if you're gonna buy stock, like you're probably gonna look at the business. Most folks are gonna be diligencing more of like the investment groups. So that's like ETA funds, investment banks, family offices. They have their entire diligence teams and processes that they'll go into, but they're not going to be, generally speaking, like looking at diligence before they're looking to invest. It's more going to be like a transaction accountant, QOV, individuals like that will actually help make sure that everything's, you know, properly structured, diligenced, and that's probably not going to be an investor. They're going to be looking at it from the standpoint of, are we interested or are we not interested into the deal? And then your final question is, I don't think it's mostly going to be cash flowing Main Street businesses. So like no distressed businesses. It's not something we're focused on. Startup, we're not really focused on. Not a ton of software currently today. There's some that we're like chatting with, but I don't think there are generally restrictions on industries per se, but there are industries that are a little bit more challenging to find investors that have domain knowledge and understanding in. So
Judd, I have a question to add to that. What about businesses that have high concentrations like GovCon or maybe an oil O&G industry, kind of like that?
Yeah, I mean, those are for folks that don't understand those industries. I think they find that unattractive, and individuals that do understand that oil and gov businesses can only have a few customers. So for some individuals, yeah, it's not going to be interesting at all. But and then yeah, there's other concentration of customers, and I think having a strategy about how you're going to retain those customers. There's ways that you can, you know, have a like forgivable seller note attached So if the customer leaves, we're not going to pay out X amount. You could also, from the lending side, basically equate the cash flow of that customer and then decrease the loan value for that individual customer, which then would mitigate against those risks. So I think there's like ways to mitigate against any customer concentration from an investor, and then also strategies to retain, like maybe the seller has to sign a contract with them for an extended period of time, post acquisition. There's ways to like get around it, but it's always going to be a little bit of a red flag or a contemplation.
Yeah. Well, there you go, folks. Judd, thank you so much for doing this with me. I appreciate it greatly. And if you guys need to reach out to me to go reach out to Judd, is mainshares.com/r/John. He has got a book schedule because it's just going right into Calendly or whatever he uses. He's booked out. You guys have a question for me? I'm on LinkedIn. You know how to find me, or just send me an email. So thank you so much for joining us. And yes, we did record this, and yes, it will go out.
Thank you, John, and thank you, everybody. Appreciate it.
Great seeing you guys. Take care.
Thanks.
Yeah.
Thank you.